I've called 5 of the last 2 recessions. My track record speaks for itself.
Now the private equity fund cast is about to begin. So give it up for your hosts, Devin and Jim.
We're all gathered here today for the final funeral of the software industry. SaaS is dead. Software is over. AI is our new king. Or not. Maybe we're just in another transformation in the technology industry that people are trying to figure out real time. And boy, is it an exciting time to be alive. So I've got my trusty sidekick here, Jim Milbury.
Good to see you, my friends.
Jim doesn't need a black suit for the funeral because you're always dressed in black. So you're appropriately dressed every day.
Yes.
For the funeral that is about to come.
But I did wear dress shoes for you today. Usually I have sneakers, as we would say in Boston.
I was going to say, the
sneakers.
monk strap is a good look.
I like it.
With the golf shirt. But I do appreciate you wearing almost all black today. Here we go. So here's what happened. And you can read all about it on Substack. We've got a long piece called The Ghost of Software Future. And this is the companion piece. So we're going to walk you through a little bit of a history lesson and a whole lot of field notes from the front lines of what's going on in the software industry right now, what we think the market's getting right, what we think the market's getting wrong, in the lens of lower middle market software companies. We're not venture investors, we're not mega buyout investors, and we're not public company investors. We're talking about the mom and pop software companies of the world. But to give you a little perspective of what we think is going on here. So, all right, so February 23rd, Jim, it was a dark day. I woke up to a stream of texts in my group chat, an email box full of the same email from dozens of people saying, is this the end of software? A little-known investment firm and research firm called Citrini had dropped an article basically predicting the death of software and AI, a thought experiment about 2028. About what the world would look like.
And with the dark clouds coming over the sky, did you feel like, the end was nigh? Did you feel like enterprise software people would somehow be swept up into a heaven of per user pricing where we would live out the rest of our days? I think the answer is no, but
once I got a sense of what was happening, because this was, not a usual day.
Yeah.
The markets were down 5% before lunch. Large brand name software companies were getting the legs cut out from them from an evaluation. As I read through the Citrini thought piece, I connected it back to a few other things that have been happening over the course of the last few months and realized, the market's just woken up that we're in another one of these tech transitions and they've decided it's too hard to figure it out. So they're just going to sit on the sidelines.
I mean, the scary part is, we talked about lots of reasons why that happened, but it wasn't like we didn't see this coming. I mean, some of these came really fast, like the iPhone sort of wiped out changed the whole mobile and BlackBerry almost overnight. We've been seeing the AI thing coming since our first episode in 2023. I mean, this train's been coming. And so I don't know why they were all suddenly frightened in February that this is the end of enterprise software. So
in reaction to the Citrini article and all the other Substacks that are out there predicting the end of enterprise software and the destruction of the American economy as we know it, we wrote a piece called The Ghost of Software Future, where today we're going to walk through the case for and against AI in the enterprise software world and how we see it as lower middle market software investors. So that's what today's episode's about.
So if we were going in the spirit of the ghost of Christmas past and the ghost of software in Ryan Reynolds spirited, I would say to the Srini guys, good afternoon.
So we're going to walk through the history lesson. We're going to walk through what's happening in the markets, which is dangerous since we're not public market guys, but we have opinions. We're going to walk through what's going on inside our portfolio, a dozen software companies dealing with this real time, and then maybe elevate a little bit and talk about what we think this means, for the near future, at least, since hard to predict too far out into the future. And let's just be honest, we have a trade on here too.
Yes, 100%.
What came out day after the Citrini article, wiped out $1 trillion of market cap. They had a trade on. They were short a bunch of the names they mentioned in the article. Good for them.
Yeah.
Totally fine. Now, they didn't They didn't tell anybody that when it came out, and the guy who had the trade on, his name wasn't on the report, who helped write it. That's a little tricky. Back to our friend Jim Chanos. He would have been on CNBC as like, I'm short all these stocks. Let me tell you why.
100%.
Yeah,
Yes.
that's his move.
Yes.
Not the, hey, let me freak everybody out and make a trade. Now, this is Lotus, which is the name of the investment firm that had the trade on. We have a trade on too. We're long enterprise software. So everybody, we're talking our book here.
Yes.
So, listen with a dose of humility and caution. We need enterprise software to work.
We do.
For you and I to make it to our funerals someday.
We'll make it to our funerals. just a matter of when. Yeah.
So let's talk about the pattern. So we'll break this up into 4 or 5 different chapters. So platform shifts, technology platform shifts always lead to the death of the incumbent.
Of course, right.
So since you're our resident old guy who knows software, let's do the first one. PCs are going to kill the IBM mainframe.
Yeah. So, I mean,
for our younger listeners,
what's a PC?
What's a PC?
Sure.
What's a mainframe?
Yeah.
Like what time frame are we talking about?
So
here?
if you look at the by the 1970s, mid 1970s, right, and IBM sort of dominated the computer market.
When was the 1970s?
Yes, you were mostly alive then.
I was at a Who concert in 1971, dude. I don't know, at Saratoga Performing Arts Center. I don't know where you were.
KISS 1978, Cape Cod Coliseum, probably.
Amazing.
I mean, you had to see the Jay Giles band. I'm from Boston, so it was a legal requirement, much like military service in certain countries in Europe.
Okay, so PC kills the mainframe. When is this happening, and what's going on?
So it's more 1970s was IBM dominated. The government got involved, and they had a consent decree which changed the way the rules worked, and everybody realized there's a lot of money to be made in computers. So DEC, Wang, Alexi, Alliant, Sequence, Pyramid, there were dozens and dozens of these companies, right? But it proved that the mainframe, it wasn't the only way to do things, but it didn't kill the mainframe either. The mainframe was still used for most of the large workloads, as it still is today. And we have a trade in on that too. Like we're long on mainframe. We think it's here to stay, and it does some very good things. But, the next thing that happens, of course, is PCs come along. You want to connect those PCs to something. Originally, they were just standalone workstations where you did word processing and maybe used VisiCalc to do some spreadsheets. Let's connect them together and do a network. And suddenly, we can do everything on PCs. Yeah, you can't. The PCs became a powerful terminal to a mainframe or MIDI computer, but they didn't eliminate the need for enterprise software. They didn't eliminate the need for those machines. Now, the machines consolidated on their own.
So first wave of this, and there's going to be a pattern here, everybody. The idea was PCs destroy the mainframe.
Yep.
No, PCs just expanded the TAM.
Just expanded the TAM.
There's more computers, more software, more everything, not less.
Right.
And mainframes didn't go away.
Right.
So let's talk about the next transition, which is client server kills the terminal.
Right. Well, that was we were using
what time
the PCs
was this?
as terminals.
Are we still in the 70s?
Now we're in the 80s,
Okay.
right? So,
I'm at the Asia concert at Saratoga Performing Arts Center, Heat of the Moment tour.
okay, I had a bad flock of seagulls haircut, I'm pretty sure, and I just graduated from college. So if you look at it, originally these PCs weren't that powerful, so they were sort of local desktop things to do word processing and terminals connected to a mainframe. For those of you who don't know what a terminal is, we've got one right here. It doesn't connect to the internet. It just connects to the only computer it knows, right? Same thing with the terminals from the manufacturers. PCs changed that. Well, they got powerful enough that why don't we just run some workloads on these PCs and keep the database on the back end, client server. Well, client server is going to get, every application is going to be client server. That's the only architecture we're ever going to need for a go forward basis. Oops. Then the web browser comes along like, oh, this is a pretty cool way.
Okay, so what had happened with client server? More software, more people using it, more access, bigger TAM.
Bigger TAM. And you're still using a lot of client server applications.
No,
go
you're
to any
not.
airline or bank. Those are all client server applications because that's just the way it works best. Even our analysts, you're not going to want to run Excel in a browser. You want to run it with your powerful desktop station, talking to your computer somewhere else. So
you just broke everybody's heart. That
I know.
Using client server every time they upload.
I know. And they
open a
so
spreadsheet.
wanted to say we're browser, not client server, but browser comes along. It's going to kill client server. It didn't, but browser made it super easy for a whole new class of enterprise application software to deliver to the customers. Why? It had a super easy distribution model. You already had a browser on your desktop. You didn't need to get a disk. You didn't need to download anything. It was right there.
And the poster child for that is Netscape goes public in 1996, I believe. Mark Andreessen, a U of I grad, so, go Illini, comes out famously with the Netscape browser. Goes public, trades up to a $3 billion valuation. I mean, the first time we had seen this in our lifetime.
Yes.
Maybe we missed the railroad boom in the 1800s. But
I watched a lot of History Channel, so I don't feel like I missed it.
This is pretty. So he comes out. He's the new electronic messiah, the cover of Time magazine, the cover of The Economist. Famously says,
this is before he looked like Egghead on the old Batman series.
He had hair back then.
Yes,
so the Egghead was covered by some.
Now it just looks like Vincent Price in the old Batman series.
So he comes out. How did he turn out, by the way? We'll get to that later in another episode. But he famously says, I'm going to reduce Microsoft to a buggy set of device drivers. So Netscape was going to kill the incumbents, the old school guys who needed to go, because it was old technology and we don't need this stuff anymore. We have the browser. What happens 3 years later?
Well, that's when the Bill Gates Eye of Mordor, turns quickly to Gandalf as he looks into the Seeing Stone and basically put him out of business. I mean,
by 1999, Internet Explorer had 99% market share in the browser market.
With the government trying to stop them, with Netscape trying to stop them, with every internet startup that was going to try and compete in the browser wars trying to stop them, still.
So we all know what happens to the browser. There's still mainframes. There's still terminals. There's still client server. There's still PCs.
Yes.
And now there's the browser. It expanded the TAM. It made more people using the software and made it easier to use, and obviously started.
Right, because who uses Internet Explorer now? I mean, obviously nobody, because they don't even release it, but Edge.
Some WorkWave customers.
Yeah, somewhere, yes. Fair enough. Pest control software. You get it, the dirty PC desktop, still running Windows 95. Yeah. But if very few people are running a Microsoft browser. In fact, any of our associates, they don't even really, like, Microsoft makes a browser, because why? They're using Google or DuckDuckGo or Safari or something else. Like, again, it's huge market, and companies have built huge businesses around a technology that Microsoft dominated just way back 20 years ago.
Yep. So now, so what happens in Netscape? It gets bought by AOL.
We're all
frowny face emoji.
Frowny face goes to die. Ooh, you've got mail. You're out of business.
So now mobile comes along, and mobile's going to kill the enterprise.
Wait, so you're saying to me, just so I get this clear, that instead of turning Microsoft into a set of buggy device drivers, Microsoft turned Netscape into a bunch of buggy diskettes that you got in the mail. That's what you're saying.
100%.
Got it. Okay, I'm with 100%.
You now. So let's fast forward to the iPhone. Was that 2007 or something?
Yeah, 2007, 2006.
Yep. So what concert would I have been at 2007? Probably like a Pavement concert, maybe, or something like that.
Now you're getting hipster. I'm going back.
My musical taste got better.
What was that? I was probably going to see Styx, and with whatever new lead singer they've got.
Totally. So now mobile comes around, and the whole pitch on mobile was death to the enterprise, rise of the consumer. Everything's going to be apps. It's all apps.
Yep.
Goodbye Oracle, goodbye Microsoft, goodbye SAP, goodbye all the big boys. Apple has now won, and everything's gonna be an app.
Yeah, I thought you were gonna do that with the goodbye software, goodbye Oracle.
So what happened?
It turns out that to power all those applications, you need enterprise data, which happen to live in Oracle databases, mainframes, file systems. Yeah.
Again, this is not saying. I mean, the iPhone obviously worked. And it was an amazing thing, and it expanded the TAM for everybody. Yes. And what happened? SAP famously buys 40,000 iPads for its employees, and basically domesticates consumer for enterprise applications. It's now a delivery mechanism with something that's relatively easy to use. Behind those apps is a lot of enterprise software.
But think about this.
And Apple cuts deals with Microsoft and everybody else.
But we're talking about major trends that everybody knew. There's dozens NoSQL databases. We'll eliminate relational databases. Pretty sure Oracle and Microsoft SQL Server still dominate the market for maybe MySQL within that. But again, also owned by Oracle. There's a million of these. Lotus got wiped out by Microsoft, and they in turn had wiped out VisiCalc. This is more about companies, not technology, limiting the growth.
Yeah, and then you've got the cloud transition, which is probably the most relevant in my view to what's happening now. is everything moves from on-prem to the cloud, or compute happens up in the cloud and soon to be apparently in space. In 2012, AWS had won. I mean, shocking on its own that Amazon, a book distributor, basically becomes the dominant cloud player in 2012. Google is playing catch up at that point, Google Cloud, and Microsoft is nowhere to be found.
Or Oracle, or the other 10 big software companies in the world, nowhere to be found.
So fast forward.
Rackspace was probably the biggest guys in the business.
Fast forward to today. Microsoft's Azure is a $75 billion business. They caught up and figured it out. And Google has built a very nice cloud business around it, and AWS continues to thrive. Again, expanding the TAM, new opportunity. Water finds its own level and fills the void.
And now people are, famously right here in Chicago, DHH and Jason Fried pulled everything off the cloud and built their own data center again because it turned out to be cheaper. So now we're even figuring hybrid cloud is probably the way. It's on-prem on our own private thing. Oh, no, it's all in the cloud. Oh, no, it's a hybrid. So, the reality is as computing power changes and technology change, the architectures are going to change under the covers. They always have.
So we've been through this before, and as they say, horses for courses.
Yes.
You now have a buffet menu. You can choose what you want to do, and each of these big transitions makes it easier to choose the best solution for you and your business and your customers, and also generally expands the TAM.
Yes.
And makes it a lot more complicated for anybody to figure it out. So you've got these big whipsaw swings in our world, and what's a company worth? What can it be sold for? What can you buy it for? And what are you going to do with it after you own it? And the public markets, you see that happening in real time. And so we're kind of using them as a proxy. I think our summary of this section of the pattern is this is the cycle of evolution.
Yes, always.
None of these have been revolutionary. They've all been evolutionary if you know your history.
Yes.
Most failures of application companies, software companies, and languages, programming languages, some mostly are self-inflicted.
Yes.
Right? Rather than homicide, some competitor coming and killing you when you didn't know they were coming.
It's almost always, Clayton Christensen's the innovator's dilemma. I mean, it's almost always. They got great. I mean, they got great market share. I mean, Oracle got saved. They missed the application server marketplace. They got saved because BEA made some missteps, and they bought BEA. We're doing very well in the ERP marketplace. PeopleSoft had a few missteps. They were able to buy PeopleSoft. They bought their way into all these markets. So.
And for those of you who are right now wishing that there was a podcast where Jim just talked about this forever and ever, there's going to be the TechCast, which will be coming out soon. So check your feed for the TechCast, where you can listen to Jim talk about this literally all day. But I'm going to move us along here.
It's like PE Funcast after dark.
Exactly. I'm going to move us along here. Steve Sinofsky, who ran Windows and Office at Microsoft, has come out recently on a piece on A16Z's Substack saying AI is just making the making of the software is getting easier and easier, just like Visual Basic, just like Java, just like all these big transitions. But what to make is still just as hard. And
that's always been the hard part.
If you listen to the Jim going on and on about these transitions, it's like every 10 years, the ghost of software future appears and shows you what the world could look like if you do or don't, heed his warning. Maybe it's a her, maybe it's a they. I don't know what pronouns the ghost uses, but the ghost always shows up every 10 years and basically says, this is what you're facing. Some people view that as a premonition. Some people view it as a briefing. Famously, Microsoft, given their success, viewed it as a briefing. And Satya Nadella got the memo and completely transitioned the business and turned Microsoft to what it is in today. But let's take the bear case for what it is, which I've been called a perma-bear, given how I invest my entire career.
That's a good name, perma-bear.
I'll take the perma-bear.
It sounds like a competitor to like a good cooler or drink cup company.
I've called 5 of the last 2 recessions. My track record speaks for itself. So there's 4 arguments for the bear case. So let's quickly list them and then we'll go through each one of them. So 1 is private credit destroys us all. 2 is seat licenses go away, so the revenue model blows up. 3 is vibe coding. Like you could just vibe code this. And 4 is we're in an AI bubble, which is kind of the counterfactual to the first 3, that
Yes.
none of this stuff works and it's all going to blow up spectacularly. So let's take each one of these. So private credit. This is real time. If you're in the current time, March 2026, right now, there's a lot of buzz around private credit. What is private credit? Well, after the GFC, the global financial crisis, the regulators were like, we kind of don't want all these loans in the banks with depositor money being put at risk in risky things like home mortgages and bad private equity credit. So they had to find a new way to do it. So institutions that generally would be like private equity funds raised private credit funds. So now instead of depositor money being put in risky investments, it was just institutional capital. So like the big boys who can withstand, the ups and downs of the market or something, but highly illiquid. Right? If you go to the bank, you can get your money out. That's a problem because there's always a run on the bank when things get bad. But with a private credit fund, if you want your money back, they say, hey, read the document, man. You can't get your money back. So what's happening right now is most of these funds have 5% a quarter limits on redemptions. Hey, I gave you $100. I'm nervous about where your investments are going. I want my money back. I'm like, great, we'll give you $5 and come back to me in 90 days and I'll give you $5 more. So it would take 20 quarters to get all your money back, right? That's kind of how it is. That's kind of the redemption limitation.
Yeah, but you have to do it that way.
Yeah. Oh no, because it
creates buffers in the system.
Yeah. So 75% of the money in private credit right now is institutions, like people who would invest in our funds, pensions, endowments, insurance companies, et cetera, et cetera, et cetera. But given the rise in private credit in the last 10 or 15 years, it's gone from about $300 billion in private credit to $3 trillion, right? So massive expansion of that. Again, they need to deploy it. It's competitive. They're maybe making investments that are a little riskier than they normally would have. No different than when there's a glut of capital and things that you have to do. So what's happening right now? People are getting nervous by the Citrini article and the Metcher article and tech stocks being hammered. They're looking at, I just got put in this private credit investment that's illiquid. So 25% of that money is doctors, lawyers, dentists, individual investors. Their brokers said, hey, I can give you really good returns. And based on the math and the history, private credit defaults at lower rates than public credit. We all know that's probably not true. There just isn't enough data, but because you can never get a higher return for something that's less risky. I don't know. That's what I was taught in art school.
No, sure you can, right? Isn't that what they all promise?
That's what I was taught in art school, but
right.
what do I know?
Zero risk.
But what happened is the market is freaking out that software companies are going to be obliterated, largely because the people in AI are telling everybody, we're coming for software, we're coming for your jobs. People have made in the last 5 years commitments to illiquid private credit funds, and they want their money back. Now, what Apollo put up the gates, meaning there's 10% request for redemptions, we're only going to give you 5%. Cliffwater, I think famously in the last week or two, had 11 to 14% requests for redemption. They can only give 5.
Wow.
So they put up the gates. I can't give it to you. Some people are cutting deals with other investors to liquidate, to give people more than the 5% they asked for and get anybody out. So like a Blue Owl has cut deals with some big, large institutions to help with redemptions. So again, this is just a mismatched duration issue in the private credit world. A big percentage of their investors expect immediate liquidity like you have in the stock market. I hope their advisors who put them in these funds explain to them that's not the case. Doesn't matter. Investing is an emotional decision, not a rational decision. So there's a lot of drama and worry, and you have some very famous, let's stay on the software side, software credits that are underwater. So you have Medallia, which was owned by Thoma Bravo in a take private. You've got a company called Fenestra, Pluralsight. Some of these big mega buyout software deals, the credit is distressed or heading towards distress or has needed some funky things to happen to kind of get it back clean. People are worried. And if the debt is worth less than $1, like 100 cents on the dollar, that means the equity is completely wiped out.
Right.
So you're seeing this all in the news. There's certainly some maybe hyperbolic headlines out there around what's going on. Is it systemic like the GFC? I don't think so. If you had hundreds of billions of dollars wiped out in private credit, that would be a couple days of Tesla's market cap trading up and down. The system can withstand it.
Can withstand it, and you're not going to see that anyway, but the system can definitely withstand it. I mean, you're going to see the equity wiped out before the credit's wiped out in most of those deals.
Totally.
Right.
So, and I think what we learned in the GFC was the lenders who behaved and said like, hey, this is tough, like TXU and some of these very large deals. The investors who owned the equity worked it out with the banks, extended the duration of the investment. And was it a successful investment? No, but it was a complete wipeout. Generally not. People being patient wound up turning out like not as disastrous as before. Maybe the equity was wiped out, but the credit, which all recessions and downturns are generally credit driven, and this one too. The damage you're seeing in the software of these mega software businesses that have leverage on them is not because of AI. It has nothing to do with AI. AI has not come for their jobs, has not made their competitors more competitive yet. It's a leverage story. They raised a lot of leverage when it was really cheap. Rates went up. The business didn't adjust, didn't get profitable. But this is basically, it wasn't the businesses were not profitable enough to pay debt at its new rate.
Right.
The interest is new rate.
But they thought they were going to grow into it.
Yeah, they thought they'd grow into it. They thought the rates would stay low, lower for longer, right? So that was the whole thing. It didn't happen. So this is not an AI story. The private credit is not an AI story. Private credit is a leverage story, 100%. And we'll see how it goes. But my sense is rational investors on the equity and debt side will sort it out, and good management teams will figure out a way to work their way through it. I'm not saying to save the equity and 100% of the debt. I'm saying to make it not systemic in some house of cards that comes.
Yes, which is important both from just the losing those dollars and keeping those companies alive to have lots of customers that you don't want to leave in the literally the dark.
Yeah. I'll make one quick prediction that it probably slows down the growth of the private credit industry from the retail side of things, where we were on a trajectory like it was going like this in terms of growth. Maybe it flattens out a little bit because that next dentist or doctor has read the headlines and said, well, I'm okay in treasuries. I don't need to try and chase some yield because the risk doesn't seem to be worth the reward. All right. So
you're worried about JT Marlin at this point, I assume?
Exactly. So seat licenses. Software is always in a pricing change.
Always.
We're trying to optimize pricing at all times as investors.
Okay. That's right. Yeah, as investors,
investors, you're trying to optimize pricing. Can I charge more for this? If I charge this, got to get higher retention. Yes. It's the first thing you do when you buy a software company before you buy it is you assess the pricing power of software. And software has had phenomenal pricing power for the last 50 years.
Because the gross margins is so awesome, right? You're not a manufacturer. You don't have a bunch of raw materials.
Because a lot of companies can't run without the software. So it's like, I'm going to dare you to leave. Would you pay me $1 more?
Yes.
Pay me $2 more. Would you pay me $10 more? And maybe they go find a replacement at $10 more, but maybe not 1 or 2. So there's always been this. I mean, one of the reasons why people love software is because it's super sticky and you have pricing power. That has not changed in the last 90 days because of AI.
And it will never change. And do you know what's the reality of pricing in the software market is? What happens is, it's always changing, right? From, are you charging by the CPU? Are you charging by the seat? Whatever it is, right? They change the models around. In any industry, in any sector, database sector, you name whatever you want, the one guy gets weak and he folds on pricing and it changes the pricing model for everybody. Either they go out of business or, every software vendor in the world that made a programming language charged a runtime fee, 4GL.
Yeah, so
they didn't.
So seat-based pricing is not new.
Not new.
Yep. To a lot of people writing Substacks, this is like, oh, here it comes. Seat-based pricing is under pressure. It's been under pressure forever and ever.
Yes.
The CFO doesn't look at the CFO of a big enterprise isn't looking at what's my per seat cost.
No.
The CFO is looking at how much am I giving Microsoft?
Yes.
How much am I giving Oracle? How much am I giving lower middle market software company owned by Parker Gale?
Yes.
Not per seat. So we had this big move to consumption pricing in 19, 20, 21, 22.
Yep.
Those public stocks that had great consumption pricing, a Snowflake, people like that, look at their stocks. They went through the roof.
Yes.
And what happened when everybody pulled back on software? Those stocks got absolutely hammered because consumption pricing was supposed to be the new per seat pricing. We experimented with it across the portfolio. And in some cases, it is the perfect model. In some cases, it's an imperfect model because...
Well, you know what they're going for now, right?
What are they going for now?
They're going for outcome pricing. I mean, that's what the AI guys want eventually. Outcome pricing. Like, give me a percentage of your savings or percentage of the solution from what, like,
also,
we just keep
also
repackaging the
not
stuff.
brand new.
Not brand new.
The healthcare industry has been doing this.
Healthcare, big consulting firms.
Yeah, they've been doing this forever.
Years.
So again, we will figure this out.
Yes.
There will be, what's your impact to my business? How much do I want to give you? And you could do the math. Sure. How many people use it divided by, how much you're spending versus how many people use it. There's your per seat pricing, but you're just paying $10,000 a month. Has nothing to do with if there's one person using or 100 people using it. That'll be in some model.
Yep.
There'll be some
CPU based, some processor based models.
Processor based, token based, outcomes based, consumption based.
And as of yesterday, the newest entry, IBM Bob. So it can be Bob coins.
Really?
Yeah, I got 50 Bob coins for downloading the new Bob the Builder. I mean, seriously,
Amazing.
A company that's been around that long with the worst marketing ever. I mean, don't they remember Microsoft Bob?
Absolutely amazing. So you're going to see as agents proliferate through the enterprise, there's already API fees and API pricing. There's tiers of API pricing. Like none of this is new. The idea that people have said, seat pricing is going down. I think, across our portfolio, very few of our companies charge per seat.
Very few.
Very few.
Right.
Like it costs $25 per month per user to use my software.
Yes.
No, it's usually like we're dealing with this much data or we're this valuable to you. Like we'll charge you this. And some people pay more, some people pay less, not per seat, but per kind of like the value that they believe that they're getting. And it's always negotiated in a contract.
Well, especially any of the, any enterprise level, you're a $500 million company, not a software company, manufacturer, people that buy all this stuff. You're not paying retail price with any of this stuff. It's getting packaged for you.
Yeah.
So you're signing package deals, which by the way, is what gets you into, you're not getting a package deal from Oracle if you're not taking all the stuff that you need that they make one, you're going to have to use theirs, right?
Yeah.
That's what happens in those things. But you're getting all you can eat pricing in a lot of these places.
Tie up the price, the seat pricing thing. One, the irony that OpenAI and Anthropic charge $20 per month or $200 per month per person who uses it. I mean, they're in a seat-based pricing model anyway.
Yes.
And they're talking about outcomes-based and all this stuff. Well, how do they run their business? One, they're doing it literally per seat per month. No long-term contracts. You can cancel anytime, right? The worst kind of pricing model. That's one. And two, we're going to figure this out. I guess if AI nukes half of white-collar jobs, then you'll probably pay less for the software because only half as many people are using it. Or maybe you'll pay twice as much for the software because it's that much more valuable and it's half the price of an employee.
Yes.
So you can pay more for the software. So we're going to figure this out. Software companies have been figuring it out forever, just like widget manufacturers have been figuring this out.
Yeah, but it's even more extreme here because what people are missing is we have a whole new dimension, not this the stupid outcome dimension, but you can start to price by functionality of model, right? So if you look at what Anthropic came out this month with a study of like where realistically, where is AI very capable? And in coding, business functions, research, memo drafting, reading documents, whatever, it's highly functional. And we're fraction of the people using it. I mean, literally fraction. You can almost see it. In the other areas where it's semi-functional, it's going to get functional in those areas. They're just going to charge different prices, right? So if you're doing, entry-level research stuff, maybe you're paying $100 a month. If you're a hotshot programmer, you're maybe paying $50,000 a year for your equivalent. But if that makes you as good as 3 or 4 developers, the company made money despite both ends made out on that deal, right? So, it's just, I think we've broken open pricing into, it's going to be really interesting, and pricing creatively is going to exactly how we're going to have to do these things.
We'll figure it out. As an industry. Vibe coding. So let's give another quick little history lesson without getting into full tech cast mode here. But so Visual Basic.
Yes.
Open source.
Yes.
Low code, no code.
Yes.
before we get into whether vibe coding is happening or not happening at the enterprise, like walk us through the democratization of software creation. Apparently, this is the newest thing. This has never happened before.
Never happened before that citizen developers could write stuff. It's only happened every single time. So, typically when you're writing software, you got to translate your instructions written in English and a syntax into a language the computer understands, which is binary. Doesn't matter how that process works, right? We do offer the best mainframe debugger product for those of you who are interested. So literally that's hard to do. You have to know what you're doing, and writing at the machine level is even more difficult. So C, COBOL, those languages were much easier to use in the machine level coding. Then along comes things like Visual Basic.
1991, Visual Basic.
Even easier. Now, Power Builder, Uniface, they'd all come around. But Visual Basic was the cheapest, easiest used tool to build fairly complex screen-based applications. But it's still,
Introduced by
Microsoft.
Yeah.
And again, they didn't invent that category. Power Builder, Gupta, Anabase. I mean, there's a lot of 4GL products came along before this. It's kind of waited around just like they did with Explorer and said, okay, then. And they had the best distribution model, so because they already had your desktop.
So Visual Basic in the early 90s was going to democratize
everybody's going to do it.
And it did.
To a large degree. Yeah, it did. A lot more people weren't necessarily that skilled to write software. Now, most of those applications, if they got up to an enterprise grade level, we ran into problems because you had a bunch of single developers that were banging away and trying to put that stuff together that didn't actually work, right? So along comes Java. People go back to kind of the 3GL thing, and then right before this wave hits, if you look at kind of the last 5 years, it's been the rebirth of low code, no code. I used to call it 4GL, right? Yeah. Okay, we didn't make it with that branding. What about low code, no code?
So we see over the last 20 years, we've seen hundreds of low code, no code deals.
Hundreds of them.
Hey, you can just drag and drop. You don't need to know how to program. You could just do this. You can build applications. Some are actual tools,
yes,
and some are companies that are built on low code, no code, and allow their customers to hey, you want to customize this? You can customize it. Just drag and drop.
Yeah,
right.
I mean, and there's a whole bunch of them out there that have been. Appian's been around for a while. Betty Blocks. I mean, there are a lot of them been around for a while, and that was always, by the way, the closer you get to the machine language, the more flexible it is to do exactly what you want.
Gartner famously says 10 years ago that the next 450 million apps, however they pick that number out of their hat, will be built using low code, no code.
Out of their hat? I would have suggested somewhere else, but no, let's go with hat.
Yeah. So again,
wrong. Yeah.
So,
but that looks right. I mean, we still. Why did they say that, Devin? Here's the issue. Why they say that, right? They say that because, and this is so funny. Going back to the beginning of this, why they want that and they think you need that? Because we need more software. Like that's what people are trying to do is put tools in the hands that let regular people build software because we don't have enough software. That's exactly the reason they're trying to do it, right?
100%. There's not enough software.
There's not enough software.
There always needs to be more software. Yes. All right, so let's talk about AI vibe coding, which is, it is amazing. Let's admit it. It is absolutely amazing. It's democratized coding more than the other things before it. But it's not the first time this has happened. So how is it different, and what's actually happening behind the covers on the vibe coding? Real quick.
So it's a stupid name. So let's just say, Andrew Karpathy, one of the co-founders of OpenAI, who's not there anymore famously, but he coined the phrase of you're sort of just vibing your way through an application development. It's not that. It's using structured descriptions of what you want the machine to do. You hand it to an AI agent or a piece of software, and it in turn develops that code, right? So you're taking the developer who's a better architect than any AI engine. AI doesn't think. It's basically just doing pattern recognition. So you say, I need to build this kind of application, and it knows how to build that kind of application. So it's all about telling the machine exactly what you need it to do. So they say vibe. I had a vibe for doing this, but it's much easier. It's definitely a force multiplier, especially for senior people like me. I'm a really good architect. You wouldn't want me checking code anymore because I don't look at the syntax much. I've built more applications in the last 4 weeks than I probably built in the last 20 years because I know what a using look like and I know what I want to build.
And you can in not knowing the language, using natural language instructions.
Yes,
you can tell the machine what to build.
Yes, and if you're interested in this, the first episode of the TPE TechCast features this exact issue.
Yeah. So why isn't this going to destroy enterprise applications if everybody can just vibe code their own app?
Because the issue is you can't vibe code an enterprise application, right? And so any pushback we got in our portfolio, right, was from CTO saying, this isn't ready for prime time yet, right? Over the last 3 months, it's ready for prime time as a force multiplier, which is they take their best people. They don't need to look at the low-level code anymore for every single thing they're doing, using the AI to generate that stuff, because AI is a much better typist than humans are. So especially for our size teams, most of the people in our portfolio companies really know their industry and really know the market. The challenge is we just can't get enough code out fast enough to meet the customer's requirements. This is 100% a way to do that, and it's very reliable.
So a smart college kid who's got an interest in the auto dealer industry, why can't he just take Replit and or Claude code and build an enterprise resource, an ERP system for his dad's dealership?
Because the AI doesn't know what the endpoint is, no matter what you tell it. You have to have an architecture. So my argument here to this point, so let me just not answer your question by answering it. People of a certain age, their parents, in my case, my mom, she was a seamstress. She bought patterns from Singer Sewing, right? And she made that dress, or she made those pants. That's where we're heading to, is you're not checking in code, you're checking in the detailed pattern of how to build one of these things. So the challenge is, could that person do it? Yes, but they don't know, how do you handle thousands of simultaneous users? When do you put caching in? What is lock management? What data structures underneath? Don't know any of that stuff, but they can certainly buy all those patterns. They can certainly inherit all those patterns. The challenge is, if you had 5 or 6 guys that knew architecture, they're going to go way fast, especially if they can grab that guy and get his industry expertise. Because now that person can talk in a language, English or whatever your language is, just conversational language, goes right into development that gives them a product they can look at that day and say, nope, I didn't mean that, I meant this. The cycles are going to just absolutely repeat. So vibe coding doesn't replace traditional application development. It's an accessory. Don't call it vibe, but it's an accessory. It's your best pair programming partner. It's your developer that never calls in sick that's just right next to you. It's awesome for that. It'll work overnight. What did people go to remote workforces for in India, or to get a 24-hour clock? These things can be writing code for you at night, and the test cases that go with it. This just expands the ability to write software, in my opinion. It's beyond exciting.
Yeah. So in the right hands, amazing tool.
Right hand's an amazing tool.
Speeds everything up.
Yes.
In the wrong hands or uninformed hands, we're going to have a lot of really bad software.
Yes.
So what has AI done for music? There's a lot more music.
Yeah.
A lot worse music.
It's really
there.
bad. Yeah.
When things are easier to do, you get a lot of slop. Right?
You do. Well, famously, OpenAI just said we're shutting down Sora. They're advanced, and they had cut a deal with Disney, for God's sakes. They had access to Marvel characters and everything else. Like, can't make any money doing it. It's not a real thing. It's just slop coming out. Right?
So again, there'll be more software.
Yes.
There'll be a lot of better software, and there'll be a lot of really bad software.
Yes.
Out there. So anyway, we're going to get to what all that means on the vibe coding front for actual companies in a second here. But let's finish it off with the counterfactual to all this of like, oh my gosh, AI is coming for all your jobs. AI is going to destroy incumbent software companies. It's going to destroy service industries and knowledge industries. Oh, no, AI is a total bubble. And when it cracks, we're all screwed. So we've never seen CapEx spending like this before.
Certainly not in the software business.
No.
I mean, if you look at what it took to start any of the relational database companies way back when, even in like today's dollars, it was probably like $150 million. It was like 15 million total for the top 4.
Yeah.
Way back when.
So we've never seen CapEx spending like this.
But it's required.
The biggest companies, Mag 7 companies, we all know the names of, one of their features for investors where they had extremely stable cash flows that could grow and could be used to buy back stock, maybe dividends someday, M&A, other things. Those are vanishing. These companies are spending 100% of their free cash flow on CapEx to build out data centers and invest in foundation models and kind of hyperscalers would be the term.
It's got a little bit of the feel. I mean, you mentioned this. It's got a little bit of the feel of building out the fiber. Way back when you just consume the fiber. These guys are. I mean, they're planning the investments for their next 5 or 6 models, like 3 or 5 years out. We're still trying to figure out their frontier models today, like getting all the value out of the models they built.
Yeah, if you look at the internet bubble, it's called the internet bubble. In my experience, it was more of a telecom bubble that bust that really hurt things.
Or a web van bubble or a pets.com bubble.
Yeah, but those things were just rounding errors.
Yes.
Pets.com and Webvan were rounding errors compared to the amount of money that was spent digging up the streets of every major city in the country to lay fiber optic cables. It was called dark fiber. We were laying this. There wasn't enough capacity. There wasn't enough demand to fill the capacity. This is why it was called dark fiber.
Right.
We're going to lay this in the anticipation of this massive boom in the internet that's going to fill up all this fiber with bits and bytes. And what happens that then you lay the cable and now you're the traffic cop. You get to charge for the use of that cable. So people were investing in futures. They were ripping up streets in Albuquerque and laying fiber optic cables everywhere. And there wasn't enough internet traffic at the time to fill it, so you couldn't charge for it. That was the telecom / tech bubble bursting in 2000. The arguments today would be against that are there are no unused tokens.
Yes.
There's no dark tokens.
No
Every
dark
token
tokens.
that's created immediately has demand for it and you can charge for it. That's the argument today, right now, as we stand. So people are building way out into the future, assuming that very quickly, the demand will fill the supply of new tokens and new capacity out in the market. If that cracks, if that is not true, largely because probably lack of ability to get credit, back to the private credit risk here, might actually be a self-fulfilling prophecy on the AI CapEx bust, is you just can't get access to the debt anymore to make these huge investments. And there isn't enough equity and free cash flow in the world to fund these massive operations. Arguments about what percentage of GDP growth is from these hyperscalers. Is it 1%? Is it 2%? Is it half of it? Is it all of it? Don't know, because the math is hard to math here. But if this is truly a bubble, and I would say it's more of a CapEx bubble than a technology bubble, the technology works.
But here's the interesting part, though. When you think about it, so the bet all the telecom providers made then, right? They laid all this fiber and it was all dark fiber. And now it's mostly lit up. Did they dig the streets up again? They didn't. It was the right technology. We got the right technology. Now, the problem is unlike telecom, so Quest getting bought up by Verizon, you don't care what fiber you're running on. You just want the fiber. In this case, you got to be careful about making too hard a bet on any one of these guys, because any one of these guys could be going out of business. But they're all really similar in terms of how you engage with them, right? Same way you're using this. Some small differences, just like there's a small difference between network route or whatever, but the underpinnings of this are right.
Totally. So the technology works this time. It's not a flash in the pan.
Nope.
Whether it can sustain this amount of CapEx, and if that were to crack at some point, there would certainly be repercussions way downstream from there.
Yes.
You should be, in my opinion, much more worried about that happening and the downstream economic effects on the market and investment and jobs than you should be that somebody's going to vibe code away your enterprise application in terms of distress to the system.
Yeah, I mean, if we're making any investment advice, which we're not, if some large company buys a vibe coded ERP system from some kid, you should short that company's stock, in my opinion.
Yeah, totally. So let's get to the next phase, which is the mispricing, kind of what I think happened in the markets. The Citrini article was the trigger.
Yeah.
People were looking for a reason.
They were looking for one.
People were looking for a reason like, I've had a great run up in these stocks. Again, do yourself a favor. Look at a stock you think that just got crushed in the last 60 days by the market. Look at it. How's it done over the last 12 months? Maybe it's flat, slightly down. How's it done over the last 3 years? It's probably way up.
Yes.
Way up. So if you were buying these things in January, you're in a world of hurt. If you're buying these things 3 Januaries ago, you're playing with the house's money. And there probably was some profit taking and rotating out of it, which was one. The cause was these frothy valuations. After 2020, 2021, there was this massive ramp up in people buying software, basically kind of the remote work thing, which was like, hey, I have a distributed workforce. My software hasn't caught up to that. I need to buy a lot more seats for these things.
Yep.
Or I need a lot more cloud. I mean, we had arguments 10 years ago. Is the legal industry ever going to embrace the cloud? Right? I mean, COVID just accelerated that, and there was a lot of spending for people to catch up to that in industries that had been behind. But growth decelerated at most of these companies in 2021, 22, 23, like decelerated from like 40% to 20%. 20% is 10x GDP growth, right? I mean, it's amazing, but the stock market rewards you for the future.
Yes.
And if you're not going to grow 40% in the future, your price has to come down today to match the terminal value at which a 20% grower is valued at rather than a 40% grower. That hadn't happened because a lot of the analysts and the management companies and the VCs and everybody else were saying, no, AI is going to reaccelerate. So we decelerated coming out of COVID, but AI is this new thing. We're going to reaccelerate growth from AI. So everybody who owns a stock is waiting to see, like, okay, it's earnings season. Where's the AI growth?
Right.
Well, we know there isn't a line item in these companies that says AI and it's, giving them 10 more points of growth.
It can't be because you're using it in so many different places. There isn't one counter.
So everybody was waiting for that, being really patient. It hasn't happened. I don't think it's going to happen, and we can get to that later. So you had people say, like, well, I'm done with these. The valuations are too high. They need to come back to earth. We, in 2023, we wrote a report called What is a Software Company Worth? Me, you, David, put that to work. And we looked at 25 years of public company data. We knew these things because this is our investment philosophy anyway, which is what is a software company worth in good times and in bad times? We broke them into two cohorts. One was public software companies that look like growth equity deals, growing more than 20% a year, irrespective of profits, either some profits or no profits or profit losing.
But
businesses.
it could be profitable if they decided to slow growth or,
But these were stocks that we would move them, over time from one cohort to the next. But we had a growth equity cohort that peaked at 25 times revenue and came down to as low as, I think, 7 times at one point, right? So 7 times for a 20% plus grower. And then there was a lower middle market cohort was that they were growing less than 20% a year and had at least 10% EBITDA margins, right? So these are efficient growers.
Yes.
They grew and they were nicely profitable. Those spiked at like 9 times revenue over this 25-year period and then came down to like 5 times revenue. So the spread was not 25 times to 9 times. It's a big spread.
It's a huge spread.
And then 7 times to 5 times. Not so much a spread.
Yeah.
There were 2 times in that 25-year period where the spread widened not to that extent in 2020, but were massive spread widening when you really wanted to own the growers. 2 times. And they lasted about 12 months each. When growth decelerated or when the market re-rated these things, they converged. It was a 2 times difference in valuation, multiple of revenue difference. So our conclusion of that is, hey, if you're going to invest in these growers at any price, growth at any price, boy, you need to know when to get out.
You got to time it. Yep.
Because if you bought it at 7 and it went to 25, good for you. But if you bought it on the
ancient Asian art of timing, as they say.
Yeah, if you bought it on the way up to 25, like, boy, you need to know when to get out when it's trading at 7. 7 times revenue is still an amazing multiple.
An amazing multiple. Absolutely.
So not saying that, but if you bought it at 8, 9, 10, or 20, you're in trouble. Our approach has always been buy below the median, buy below the mean of historical averages. So buy below 5, improve the business, and hey, maybe the worst it's been in 25 years is about 5. So in good markets and bad markets, you could sell up to 5 if you did what you said you were going to do. Or maybe you get lucky and you could sell at 8, 9, or 10 or something. Who knows? For the last 10 years, the market's been completely flipped, which is no, you got to buy the growers and it doesn't matter what you pay for them because they'll be richly rewarded. That, if you look at past transitions, hasn't really played out the way. So let's look at the cloud transition as maybe the best example of this. So this license to subscription kind of cloud transition, those software companies kind of troughed at a 15% discount to the S&P during that 2011-12 timeframe when it was like, oh, cloud is won, all these legacy incumbents are dead. That basket of stocks led by Microsoft and Oracle and the big guys you would know, traded at about a 15% discount to the S&P. Today, those same incumbents, different names, but same types, are trading an 11% discount to the S&P. So underperforming, and approaching maybe the trough of the license to subscription, kind of that cloud transition. I'm not calling a bottom,
right?
But based on history, we're kind of approaching that. Again, stock prices are way out in front generally of performance. and they readjust pretty quickly. So I think we're kind of headed there. It feels like towards maybe we're hitting that trough, and things will come back as performance clicks in this AI transition. I mean, Microsoft was trading at $25 in 2011 or 12. It's at 400 today. Adobe was at $23. This is one of the poster children of AI is going to nuke Adobe. Maybe I think pieces of Adobe, but all of it, I'm not so sure.
I mean,
it trades at 270 today.
Here's where I
Oracle,
disagree with
S&P, Oracle and SAP like kind of did okay through that transition.
If AI can remove the Adobe updater from your computer, which takes 90% of the CPU, I think that would be the end of it. One thing you said.
But again, self-inflicted wound.
Yes, self-inflicted
wound.
Yes.
Yeah.
They crammed all their companies together and they have this god-awful installer. Here's a question, though, that I think coming out of the COVID bubble, right?
Yeah.
That was probably also the most profitable any of those software companies could be. Their customers all needed new licenses and they were spending no money on travel and reps going places. That was just like easy money for 2 years, basically. Right. Just easy money.
And what did we get from that? The metaverse.
We got the metaverse. Good God.
Here's the thing.
It killed the metaverse. AI killed the metaverse.
Constraints drive creativity. When there's abundance, lots of bad things happen. Stupid decisions get made. When there are constraints, great art comes out of, times of stress.
Would you really want to be in that meeting with the Horizon Worlds with we don't know how to do legs?
Exactly. So we're in a time of abundance right now.
Yes.
It's never been easier to make software, and we're going to have a lot of software, a lot of great software and a lot of bad software. So, all right, let's get to the argument now that we're an hour into this and everybody wants to find out actually kind of, what we're seeing here is, here's my argument.
Yep.
AI is not going to replace enterprise software. In fact, I think it's the opposite. I think enterprise software will domesticate AI. And by that, I mean
the Borg. Resistance is futile at this point.
It will teach it to heal and fetch and sit and roll over. AI on its own will not tell enterprise software what to do. Why is that?
It's not deterministic. That's
AI is the thinking machine, and enterprise software is an execution machine. So talk about deterministic versus non-deterministic models and why that matters. And people know this, but for some reason they think that a non-deterministic model can tell you what the drug interaction is going to be in a 99.99999% accuracy.
Yeah. So look at first, it's the confusion, and we're going to talk about this in another episode, that AI is not a large language model. AI is a bigger industry. So we've had deterministic AI modeling technologies and algorithms, and that's how you get credit scoring at the credit card companies, or how they do drug testing and interaction. Then there's AI, which is inferential. It's not deterministic. Like, it's doing a very educated guess. It's amazing how the educated guess is, but drug interactions, or do we need to turn down or up the coolant in this nuclear power plant? Those are decisions that you can't let AI make on its own. That's what enterprise software is for. So AI is a great thinking engine to give you data, but you've got to have deterministic systems, especially healthcare, manufacturing, defense, aerospace. I mean, anything where you're talking to machinery, it's got to be right.
But AI is going to get better.
It's never going to be. It's never ever going to be, and they all know it. Like, talk to any researcher, right? The issue is going to be
LLMs will never be deterministic.
Never be deterministic. Cannot be.
Yes.
By definition. So, and was it Tim Cook at Tim Cook was
Tim Apple?
Tim Apple. Yeah, Tim Apple as our president says. Literally said that, and it's right. So it doesn't mean that it's not amazing. Yeah. It's amazing. It's cutting down all of your choices. It's phenomenal, but it still has to have things wrapped around it where people are not even thinking yet. Like, if you look at one of the most complex places to write software, it's robotics, all these manufacturing floors. AI will make that code easy to write. Man, is that going to drive margins? Because that's, any large manufacturer, that cost, right, is setting up those factories. I mean, to be able to optimize that technology is going to allow us to really build stuff too. So, I think they're way off base here, that it'll never be a person. It's never, and we talked about this in the predictions episode. We are eons away from, just like we're never going to Mars and we're never living on Mars, from, AI replacing humans.
Yeah.
It's not going to happen.
So,
it's like trusting my kids to take the trash out. There's an 80% chance they'll do it.
Yeah. So Peter McCrory, who's like the chief economist at Anthropic, this is in February, where everything's melting down. he was speaking to all the enterprise customers, who are watching their stocks get annihilated, watching people saying AI is coming for you, all this stuff. And he's like, whoa, wait a second. Like the constant isn't the model. The constant is the data and the infrastructure.
Yes.
We need to cooperate with each other. We need the infrastructure. We need the data for the AI to work. Again, AI is the thinking machine. Software is the execution orchestration machine.
Right. And what is missing today, Devin? So we're just as an industry starting to absorb DORA. Sort of the DevOps is the way to make your software more reliable and higher quality, right? We have nowhere near the infrastructure that we need to truly leverage AI's ability to produce code for us. We have to get amazingly good at DevOps so that this code can get from idea to production in a reliable, consistent way that's secure, doesn't corrupt your data. I mean, that's a process that requires work.
And so to go deeper on this argument, hit our Substack, PE Funcast Substack, and this Ghost of Software Future gets much, much deeper into this argument. Again, I think it's pretty clear. Jensen, the CEO of NVIDIA, again, in the middle of February where everything's melting down, is saying it is standing in front of his entire audience, an enterprise show, saying it is illogical that software is going away, that AI will replace software. It's completely illogical, and time will prove it out. The stock market is a voting machine in the short term and a weighing machine in the long term. And the voters are saying, we don't understand this yet. We'll come back to you when it actually works itself out. My prediction is it's going to work itself out as software companies start reporting their future quarters from now and saying like, hey, the world's still spinning. Customers are still renewing, and we're doing some really cool stuff with AI that isn't showing up in the line item that says AI revenue. It's showing up in all the little pieces of the business. Gross margins going up, profit margins going up, retention going up, costs to do this stuff going down generally. So, but let's move on to like the
let me just say this. The most logical thing is, I mean, he's the CEO of one of the most valuable companies in the world. My question for him would be, you must own a second jacket, right? I mean,
come on, this
is one jacket. It's a nice leather jacket. I'd like it. I don't know if it comes in men's sizes, but it's a nice jacket.
The Steve Jobsification of startup CEO.
Oh my God, I was wearing black clothes before.
Dude, you're just jealous because you thought you invented the whole wearing black all the time thing.
Johnny Cash invented it.
So let's do this on the evidence. So how do we know this to be true? Sure, we've been pontificating for the last hour. How do we know this to be true? So Roper, a public company that's an aggregator of vertical software businesses, they released their 2025 earnings and basically said like AI readiness, they're just getting hammered in the markets because they're the poster child for you've got these old incumbent software businesses that aren't innovative. You're just extracting cash flow from them. Right. I don't believe that. I think Roper is quite a good business with a very good leadership team. And they will figure this out pretty quickly is my guess. But they were just getting obliterated, like Constellation Software, obliterated in the markets. They in their 2025 release, they're like, no, AI readiness is actually driving a lot of really good stuff across our business. Like we got to clean up the data. We got to get ready for infrastructure. We need to, build these agents and do other things. They were seeing a lot of that across the portfolio, but it wasn't showing up in some AI growth reacceleration line. And we're seeing the similar things in our portfolio.
Yes.
So let's talk about like the three main line items on a P&L for operating expense: R&D, sales and marketing, and then G&A, so finance and other things. So walk us through kind of what's happening on the ground inside our portfolio that gives you confidence that software is going to survive, and these tools are great, so they can both be this at the same. It can happen at the same time. And maybe what's changed from like where we were a year ago to today? Like how have we changed our mind, or are we?
Yeah, I think so. I would judge it by our CTOs, right? So our CTOs are typically an experienced lot. They're also very opinionated, as all software developers are, and they also have really thin skin, like all software developers, including myself, are. They can what is it? My mother would say, they can dish it out, but they can't take it. Their view a year ago was experiment. Weren't preventing the developers from trying something like ChatGPT or Cursor plugin. Most of them were already using Visual Studio Code, so Cursor seemed like a natural extension for them.
Remember Devin?
Oh God, do we? Yes. Well, Copilot, Microsoft, so they were experimenting with it, but most of our team said not ready for, so, two ways you look at it, right? One is help us develop software. The other is, do we put AI in our software for our customers can use? I think the first inklings last year were, hey, this might be actually pretty good for doing test case generation because we're all behind. We use the standard joke that, testing is like flossing your teeth. You lie about how often you do it. Most of our companies, they don't have 100% test coverage. They maybe got 50 because they're small and they're releasing features to customers. Now they have good development processes, so they release quality code, but it's a slower process. We're getting to 100% test coverage. So that was the first thing they saw.
When you have 100% test coverage, you can
release very fast,
more better code faster.
Yes,
so
fix problems faster.
Replacing the typing of the code isn't the unlock. It is actually the 100% coverage on testing that is the actual unlock, because that's the thing that stops you putting out bad code.
Yep.
That impacts your customer success. Your retention goes down. Impacts customer service because now the Jira tickets go through the roof. It slows down engineering because now they're spending time fixing the bugs they released into production rather than building new stuff. Or
even chasing the bug. They weren't even sure how it occurred. Didn't even know it could happen, right?
So while everybody's talking about, I replaced the typing of the code, this is a game changer. It's like, no. You automated and improved the testing of the code. That is the unlock.
And particularly if you've got old code that didn't have much test coverage at all. It was, especially that code that had really good API, programming interfaces. You could just point, an AI engine at it and it would generate test cases, reliable test cases. And the best thing is there's no danger to the world or public. You're just testing your own code internally, but it's a phenomenal process to have down because now what you're releasing will in fact work. That was the first wave in my opinion.
All right, so let's get into the details a little bit about what we're seeing in the portfolio. So last year it seemed like you could build new stuff. You could vibe code new stuff and you could maybe build a little feature or test that's something like, hey, this could be a product. And you could do a lot of really good testing, maybe get to 100% automated testing. But it wasn't great for paying down technical debt.
No.
That seems to have changed in the last few months, that it can be now as effective on the fixing the old stuff as it is on the new stuff. So what are you seeing inside the portfolio?
Yeah. So there was, we've had a few like real leading edge people that have been, using these engines and testing out these engines, for several years. I mean, even pre kind of the launch of ChatGPT, if you will, because there was other technologies in place here. So we've had a few leading edge people. Everybody last year, I think, found two things. Definitely doing 100% test code coverage, which was great, made our software much more reliable, no bugs in the wild, without having to increase QA, which is the hardest resource to get, number one. And by the way, it's the crappiest job. Your job is to break the stuff we write. The developers will love you for doing that. No, they won't, right? Yeah. That's what an agent's great at. The other thing was amazing at was our product managers now could use tools like Figma and DevZero and Vercel and generate actual working prototypes that engineering could say, okay, I totally understand what you're trying to build. You want me to build.
Instead of literally drawing it in Balsamic or some other markup to say, like, here's what I want the button to do and all that. They could literally build a working prototype that maybe isn't connected to back-end data.
No, but most of the time it generates the back-end data to go with it. I mean, literally you have a demonstrable system. And that's given us two things. The one is engineering knows exactly what to build. The second thing is when a product manager sit in front of customers, they say, this is actually it. Like, there's not if I do this and it does this, is this what you're going to want? And the customer says yes. So that was the unlock last year. I would say and all of our portfolio companies were experimenting with that. Now we had a few skeptical CTOs last year who said, hey, I love it for, vibe coding a little project or something. And I'm playing around with my own stuff, but it can't refactor old code. It's not reliable enough to sit beside my developers so that I can throw more, work on them that, hey, interesting, not ready for prime time yet. Now, everybody looked at it because it was so good at text as to how to get it in our products. So, we had, I would say three, really leading edge, companies that were using it for engineering, were using it for test case development, and had somehow in their product last year.
Yep.
The unlock this year was our skeptical CTOs suddenly said, holy moly, like this actually works. And most of them used an old code base they had quietly, just so they wouldn't embarrass themselves, and ran it through and said, like this actually worked. Like this thing was out of date, didn't have any of the patches, any of the security. They pumped it through an engine and it updated it to the latest version, made it run. And this is where their unlock was, hey, it's ready for prime time. And now we got to go.
So how far behind are you if you hadn't started last year?
So the bad news is if you didn't start last year, then you didn't waste a bunch of money on new development. It's not completely changed in the first part of 2026. I will say that if you hadn't started at least playing with for QA or whatever, you're behind the curve a little bit in what its capabilities will do. But from making a dent in engineering, I would say now. The moment's now. If you don't have them in-house now, you don't have your developers doing it now. One, you're going to lose your developers. Two, they're using it on their own, whether you think they're using it or not. But even our most skeptical CTOs are reworking their engineering plans to use AI as part of the development process.
All right. So you've been way out in front of this piece, which is it completely changes how you manage the humans who are now managing the agents. So think about it from an organizational design, organizational behavior aspect. How do you run and manage a development team these days?
So the answer partly is we don't know yet, right? So the two things we know for sure, everybody always talked about pizza teams, 7 developers. Now it's like a small multifunctional team. It might be 3 people, product manager, a couple engineers, like literally like doing these. So it's going to be pod based. So you're going to have difficulty managing the pods. All of our companies, every company that uses software is going to have a better DevOps process and a better DevOps team, because now it's going to be, we can build stuff super fast and test it super fast. I just got to get it to my customers. So that's the pipeline part of it. That's going to have to absolutely be built up, because now you're going to have the ability to release as much as you want to and as often as you want to. So here's what it kills. It kills large teams, become smaller teams. It makes architects much more important, without a doubt, because if you have small pods, they got to know, sort of what they're shooting for in order to get any value out of this thing. And that's a sea change for most development organizations, because managing pods is not the same as managing teams that have your direct skill set. So you're going to see these weird vector-based diagrams, really, rather than the traditional kind of group diagram. Here's my engineering head. Here's the back end guys. Here's the front end guys. It's just not going to look that way anymore. So, that's going to be problematic.
So for our listeners who have kids who are in college and they're worried, and they might be computer science majors or they're early career computer science major engineers, what advice do you have for them on what this means for kind of early career software developers who may, again, they don't have the domain knowledge, they don't have the architecture experience, they don't have the miles on the road. They used to be paired with a senior engineer, and now that senior engineer has 5 agents paired with them instead of a junior programmer. So what advice do you give them?
So 2 things. What I'll say,
go into product management.
I can speak from personal experience. Yeah. I was a statistics major that graduated in 1985. Now, it took 20 years for data science to admire statisticians, so it was just late, right? Which is the same as being wrong. In this case, here's what I'd say if you got a kid in college. Go back to what were all the universities getting pushed for? Like, stop the architecture computer science courses. Like, what's a queue? What's like data structures? You just need to learn how to put your hands on tools. Yeah, that's totally wrong. Like, you need to understand why you need a queue, how a queue works. You need to understand data structures, because that's what you're going to be explaining to the AI tool, who, by the way, does not understand any of those things. It pattern matches. If you tell it you need one of these things, it's going to know how to do it. That's one. Okay? 2, if you're putting your hands on anything in college, like developing code, which you will be in computer science, work on a team project with your friends. Do not do things alone, because you're going to be coordinating with others and agents. So develop your small pods, get your stuff checked into GitHub, like use these processes. So when you're coming out of school, the senior folks at the companies you're looking for know that you understand architecture. So you can help them with the decision of what we use to process this kind of thing, not just writing the code of it. And number 2, you've used to work in a team process where you're doing a lot of delivery and a lot of deployment. It's easy to do and it's cheap to do. For $20 a month, your kid can have, what are you paying at one of these top institutions? You're paying a lot more than $20 a month. For $20 a month, they can have, for $200 a month, they can have the biggest Claude thing that they'll never use all the tokens, and they can have as much experience coming out of college as, much more than I even had. They didn't give you much computer time.
All right, let me hit the 2 other line items in the OpEx.
Yeah.
Sales and marketing, G&A, real quick. It's a skill more than a technology.
Yes.
Using AI, we're finding the best, most ambitious employees in sales, marketing, finance, accounting, G&A, are getting, it's a force multiplier.
Yes.
They're not replacing things that they were doing before. They're just doing things they never could have dreamed of being able to do before or afford.
Yes.
Like, launching a demand gen campaign in a week for a couple $100 rather than 3 months with a agency and tons of fees and tons of mock-ups and lots of back and forth. You can literally launch it within days or weeks at almost zero cost. We have one of our companies we've built with Clay and a bunch of AI, a automated demand gen machine that tracks the 20,000 North American targets they have, looks for triggers in news and other data that we have for all of those targets, and then automates a sequence, does its own research, and then puts into HubSpot for the BDR, right, the business development rep. Here is the customer. Here's the contact. We validated their contact information through a data service. Here's the play we're going to run, and here's the email to send. That is personalized to that trigger that person would have known because that's their job. So we're telling them, we just saw this. They're nodding their head. Yes, that just happened. And here's what we can do for you to make your life easier and better. That machine is running all the time. Our best BDR in this company could make 100, 120 calls a month, like dials a month.
Yeah.
We think we can get that same person to close to 500 a month. So again,
much more focused too.
Totally. And with like the right play at the right time with the right data. So instead of doing the research, instead of doing this is all automated. Now there's a big sausage making factory behind this, but all this BDR sees is the latest lead in HubSpot that they just click on and go. And when we add a dialer to this, it's going to be even faster. We haven't even added an automated dialer at this company. And then in finance, we just see our CFOs basically saying, hey, I let the machine kind of architect and orchestrate a lot of things like board decks and variance analysis and some FP&A things, but like human in the loop is still doing all the hard and analytics. We're closing the books faster with small teams, not smaller teams, with the small teams that we already have. That gives the CFO 5-10 more days a month to spend time with the CEO, spend time on cross-functional projects. Again, we're not replacing anything. We're not reducing seats in NetSuite. We're not spending less on software to do the enterprise stuff. We're just adding layers of analytics and layers of other things on top of it. Now, maybe if I was a Tableau user, I'm like, hey, I don't know if I need Tableau anymore on top of NetSuite. I could probably replace that. But again, Tableau isn't an ERP system. It's an analytics system that it relies on other people's data, now owned by Salesforce.
But analytics systems, by the way, have also completely changed over 25 years. I mean, so let's just look at Tableau killed the business objects, which had killed the SQL report writer, whatever. So this is not like, I think this is an unlock in the finance department when we can rely on the math, because you're plugging your data into that person, that CFO can think of ideas, where before they would have to say, hey, can you run me a report, whatever. It just doesn't get done. Now and
then it gets done in Excel. It comes back. This isn't really what I was thinking. Okay, you change this. Then 2 days later it comes back. It's like, no, you can actually do it real time. And one of our companies has built an MCP server, has launched has connected NetSuite and all the transactional data to that. This is across millions of transactions. And the CFO, again, he said, hey, I took 10 or 15 hours during the NCAA tournament sitting on the couch trying to get this right. So again, who has 10 or 15 hours to just tinker around with stuff? This guy obviously highly motivated and interested and curious to do it. And because we built the MCP server, because the transaction data is flowing through, because NetSuite is connected to it, he's able to do analytics that would have taken him hours or days. Now he can do in 45 minutes and play around with what if stuff. And that's because this is a ceiling raiser technology, not a floor raiser, meaning it makes your best people significantly better, not your worst people good.
Now that particular CFO in this particular case came to our SQL class for investment analysts because he was so wanting his hands on. Of course, now all the stuff I did for that is completely useless because he can do much more this is true. Like he's made these people much more effective.
So we're doing things outside of engineering we wouldn't have done before.
Yes.
We're doing things in engineering faster and better, but outside of engineering, it's like, no, is there a person in the organization who's really smart, who's curious, who wants to play with this? He wouldn't have bought this software and he wouldn't have paid more for this software. He's just able to do stuff. And at our size companies, We're just punching way
Super
above our
meaningful.
weight.
Huge.
Yeah. With 3 people in finance, we can do things that multinational companies do with a whole team in finance.
Yes.
Right. So I think this is where you get to kind of the opportunity for us, which is the ghost of software future appeared to us 3 years ago, right? August of 2023, I believe we did a podcast about OpenAI. And we viewed it more as a briefing rather than a premonition that we should be scared of.
Yep.
We called an all hands meeting. We've been all in on it since.
Yes.
We're playing with it. It's letting us punch above our weight across the portfolio, across the private equity world in which we live in. I will say I've noticed one thing. The gap between people who understand this technology and don't is wider than I've ever seen.
Yes.
That may be because it's more democratized than it's been before. For $20 a month, you can have access to the world's most powerful models and kind of a transition to the cloud. You know, you didn't just like, oh, I'm going to get an AWS, subscription and play with it over the weekend.
If what? Like,
Yeah.
I guess I'll run my own router. Yeah.
Yeah. So the gap between it, again, everybody's talking about it. Everybody has an opinion about it. Most people are using it like it's a search engine, even in our business. And I'd say on the investor side, the gap between people who understand this technology and don't understand this technology and where it's headed and what the immediate repercussions and the long-term repercussions are has never been wider. That's, again, why we saw this massive swing in February in the stock market based off of a dude you'd never heard of who posted something on LinkedIn that said his computer does all the work for him, and a dude you never heard of who was short a bunch of stocks who posted a Substack that says the world's going to come to an end in the next 2.5 years.
And now you're hearing from 2 dudes you've never heard of that are going to tell you why you don't have to worry.
Yeah. And that this is an expander,
Yes,
an enhancer, not a replacement in it.
But to be fair, it's a more complex technology than much simpler message from, terminals to client server to browser to mobile. Almost everybody sort of understood that, and everybody got a mobile phone. So they're like, oh, I get it. Maybe, and they all downloaded some apps, mostly Candy Crush, I think, based on when I was looking at people on the plane. Those back then.
I think
But
Angry Birds might
Angry
have been
Birds
the
was big
first-
too.
the
Yeah,
first one.
totally.
Yeah.
Farmville. Now I'm getting off ahead of myself there. But this is more complex because it's one of those. Well, what is it? And so that's why you got to be in it is to understand what it can do. And this is not one of those that's an elevator. It's this for this. You have to be in this world.
We are on record of saying this is an absolute gift to lower middle market software companies.
A gift that we deserved.
We finally deserve it. Why? Because the biggest lift we have in buying founder, family-owned software companies, 10 to 30 million of revenue, is they had amazing product market fit from day one.
Yes.
That's why they never raised venture capital. That's why they never took outside capital. They had a guy who built some software for them that worked right away and had customers who were like, if you build this, I will buy it from you.
Yes.
Because the person who started that company came from that industry
Yes.
and was like, there's got to be a better way. So he did the innovator's dilemma thing. I'm going to give you just enough for a great price, and then I'll build from there. We come along and the owner is saying like, do I really want to live through another transition? I mean, every transition we talked about an hour ago, we've invested through and into.
Yes.
Because it's often the reason why a founder will sell the business instead of saying like, I can't live through this AI transition.
I lived through mobile.
I lived through
browser.
I lived through all this and I don't want to do it again.
Yeah.
And
I want to buy a boat.
yeah, and I want to buy a boat. So I know what it should look like on the other side. I just don't want to go through it. And maybe now's the time to step aside, right? But the biggest lift was getting the tech where we wanted it so we could do M&A, so we could launch new products, so we could enter new markets, we could do all these things. And sometimes it took a year of just grinding it out. Sometimes it took 2 years of grinding it out. And many of our investors and investor prospects would say, do you take on tech debt? And they would get really nervous, like tech debt. Oh, we've heard tech debt, because other investments they've made, the tech debt killed them.
Yep.
Well, I would say that's more of an execution operator error than it was a systemic issue for the industry. No, I'm not saying we're going to take on more tech debt, but boy, every company has tech debt. So if they tell you they don't, they're lying. Everything you write every day is done. And AI has made every business obsolete overnight. They need to rethink this. So every company has tech debt, whether it was built 3 years ago or 30 years ago.
And founder companies, by the way, also have a lot of customer promise backlog. Often when the founder sells, like promises they've made that they haven't been able to deliver on from a feature standpoint, that AI does make it easier to deliver. You can reduce tech debt and add the features.
So what are we trying to do when we buy a business? We're trying to modernize the stack.
Yep.
Trying to accelerate growth.
Yes.
We're trying to get more wallet share from the customer by doing more things for them that they stop doing with other people and do with us.
Right, because they want one throat to choke, basically. Like, why have 10 vendors when you can have 3 that are all integrated? 100%.
So, customers don't want to leave the incumbent. They stick around with the incumbent as long as they possibly can until it starts to hurt their business.
Yes.
Why is AI a game changer for us and a gift to us? Because we now can pay down tech debt way faster.
Way faster.
And we can see it before we even buy it.
Yep.
Which we usually do. We're like, okay, this is going to take a while. We're going to have to double the engineering costs to get through this, but the payoff on the other side is worth it. Now we might not have to double engineering costs. We need a lot of change management.
Yes.
We need probably a new CTO who knows how to run a matrix organization rather than, a waterfall or agile. We're going to talk about later in another episode. Agile is dead.
Yep.
With AI,
they may not have a good DevOps process because they didn't need it.
Yeah. So we can move way more faster on modernizing the stack. We can move way faster because we know more about the customers, more about what we can do for customers, and we can show them products faster. So we can hopefully accelerate growth earlier into the investment cycle, and we can have management teams that can punch way above their weight with the tools they have.
And we've got companies that engineers want to work for because we're kind of using the latest and greatest stuff, and you're going to see it. You don't want to be, at your party on Friday night, you work for Google, and it's like, well, the new tilde they have over the N on the search pages. I wrote that.
Yeah, you want to do cool stuff.
Yeah, you want to do cool stuff.
And now everybody at every company,
Yes.
if they're ambitious enough, gets to do cool stuff.
Yes.
So one of our quiet mottos around here we stole from William Gibson, the science fiction writer, who said, "The future is already here. It's just not very evenly distributed." That has kind of been mine and your operating philosophy for 30 years, which is we're not doing anything with any of these companies that hasn't been done before. We're just bringing it to a company who just hasn't gotten to it yet.
Yep.
They know it's out there. They just like, I don't know what to do with that. I don't have a team who can accomplish that or make it work. So,
or I'm an employee. I don't want to take that risk and get fired.
And I don't want to spend 15 hours on the weekend during the NCAA tournament, like monkeying around with an MCP server to see if I could do something cool because I'm not getting paid for that.
Yeah. I think that had more to do with, trying to watch sports for 15 hours. I talked to him yesterday about it. It was a little bit of, I have to do this and I might as well have the game on in the background.
100%.
So, yeah.
So the future is already here. It's just not very evenly distributed.
That's right.
Well, here comes AI, the future. Very few companies are using it today. The incumbents
in the big way.
Yeah. The incumbents will figure it out. Some of them will thrive. Some of them will, go the way of the dodo and the dinosaur. But it's not going to be a mass extinction event.
No.
The companies that fail will be the companies that don't harness the power of this or don't believe that it's a threat for them to be worried about.
Or we're already dying just a slow death. Like some do. Like there's just some things you don't need to do anymore.
Yes. And as we've seen the last few months, the people that have wildly over-rotated on the end is near, it's over, and have dumped the software stocks or have fired 50% of their staff, they've all come back home. Jack Dorsey is rehiring employees that he fired over a press release to try and get his stock to pop. He realized he overdid it. Software investors are coming back to the big names because it feels more safe to be in Microsoft than it feels to maybe be in a business with lots of hard assets and low obsolescence. These cycles got to cycle. Pendulums got to swing. That's what they do. Our job is to help our investors and our management teams navigate those swings and avoid the pendulum as it comes swinging back to you. And on the Funcast, hopefully, explain it to you and hope it makes a little bit of sense. So thanks for hanging with us. As we teased a couple times in this episode, we are launching some new products, the first of which will be the Private Equity Tech Cast, led by Jim, where he'll go really deep on technical issues, how it applies to private equity in general and how it applies to lower middle market software companies. So they'll be coming out on Fridays, so please set your watch to that. And,
the preview of this one is how Claude Code taught an old dog new tricks.
There we go. Well,
the old dog being me, in case you wouldn't figure that out.
Look forward to it. Bye for now.
Neither this podcast nor any of the information contained here constitutes an offer to sell or a solicitation of an offer to buy any security or instrument in, or to participate in, any Parker Gale fund or other investment vehicle. Past performance is not indicative of future results, and there is no assurance that any Parker Gale fund will achieve its objectives or avoid significant losses. This podcast may contain forward-looking statements. Such statements are subject to various risks and uncertainties. Parker Gale is an investment advisor registered with the United States Securities and Exchange Commission. Registration with the SEC does not imply a certain level of skill or training. Guests appearing on the podcast may or may not be a financial sponsor of the podcast or an episode of the podcast. Parker Gale may have business relationships with certain guests, sponsors, or organizations mentioned during the program. In some cases, guests or sponsors may provide services to or receive services from Parker Gale, which creates potential conflicts of interest. Any sponsorship of this podcast does not imply endorsement by Parker Gale and is not provided in exchange for, nor intended to solicit, business between the sponsor and Parker Gale. The appearance of any guest does not constitute an endorsement or testimonial of Parker Gale or any fund. For additional information regarding Parker Gale, please refer to Parker Gale's website, www.parkergale.com, or Form ADV, available at advisorinfo.sec.gov.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Fundcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Fundcast. Pour yourself a drink and have a seat.